Right, hello and welcome back. It's taken a lot longer to do a follow-up video to the Greg's one than I had hoped, but we're back on it here. I have been trying to keep on doing some research and all that. I'm halfway through CIVI now, Civitas Resources Inc. So oil driller by the look of it, I believe. I will show you what I found so far. There's quite a few. I've looked at another one, shale, no, fracking company as well. Seems to be a couple oil things popping up on the screen here. This is just on the year-to-date performance below 30%. All US indexes and market cap above 10 million. This has popped up, and technically here, straight off start, my technical shouldn't do, but possibly got some sort of channel forming here when you see how prices reacted with this here and down there. It could be something nothing though, certainly not something to take too seriously, that's for certain. The financials is where we're going to find, you know, what we need to do. So let me see if I'm pulling up the correct one. Right, here we go. CIVI, exploration and production company focused on the acquisition, development and production of oil and natural gas in the Rocky Mountain regions. So yeah, what have we found? Well, doesn't look too bad really, does it? All the greens and the blues. $32 share price. Book value, you know, $70 odd. Reasonable return on capital in the past few years. Reasonable simple free cash flow in the past few years. So what I did with this one is I've already ran it through ChatGPT, talking about what the business does and all that sort of thing. So straight up, there were some issues with this that I do not like at all. Okay, this up here, look at this. So since 2021, let's go back to 2020, 20 million shares all the way up to 92.5 million shares. There's been significant shareholder dilution in that time. It sounds like it's a lot of acquisitions. Can we see anything that would, you know, evidence that on this balance sheet without asking ChatGPT? No, not by the look of it, because for some reason a lot of the goodwill stuff's missing from Y-Sheet's data here, unfortunately. Like I said, some of it's reasonably accurate, some of it isn't. Is there, before we say that, is there actually any goodwill on the balance sheet? Or have they taken it off? I mean, they could write it down straight away, I suppose, because there isn't any on there. So no, I take that back again. So yeah, the problem with this is the long-term debt is huge. When we're looking at the balance sheet, there's things that are counted as assets that we don't even know are actually assets. You know, there's 630 million, almost 631 million in unproved properties. So that's like places that they've purchased in the hope of finding something. That's a significant amount to lose, because how can you assign a liquidation value to that when it's unproved? You know, effectively it's at zero. I have gone through actually, and I've asked ChatGPT, because this was a learning thing. Where are we? Going to be down the bottom of this one. What ChatGPT would recommend as a liquidation value for CIVI specifically. I uploaded a balance sheet and just, as I said, would you explain to me how we would come to liquidation value from this balance sheet, because it's a little bit more full on. There's a lot more stuff on this than what you would find with like a retailer's balance sheet and stuff like that. So it's quite interesting actually with what they recommended to come back with. Now, doesn't mean anything, doesn't mean that this is actually true, but it sort of makes sense. Obviously cash, take it for value. accounts receivables, you know, I think that's a fair amount as well, because obviously there's going to be some people that won't pay. Similar treatment for the oil and gas receivables. So this is all stuff. Basically, ChatGPT has looked at my image and then decided to go down and point out things that they that it believes is worth looking at when it comes to liquidation value, like prepaid expenses and all that. Again, not really ever going to be able to claim an awful lot back from that. Property, plant and equipment. Now this is a difficult one in that it really depends on the environment and all that sort of thing. You know, say there was a shortage of wells then, and oil prices were going up, then all of a sudden, like secondhand wells and all that are worth an awful lot more. That's not currently the case, is it? Because if we get up this, have I got US oil? I mean, it's been, you know, 2022 has been in a bit of a downer. Well, I'd say a bit of a downer. It's been in a downer. You know, 50% this value it's lost since the highs of 2022 per barrel. This is. I also asked as well, like, what because obviously the input for their revenues is the cost of oil, the cost of gas. Their revenues basically relies entirely on that because they're drilling it. Future analysts' opinions. I have asked it in this ChatGPT conversation, but trying to scroll up and find it would be a waste of a video. But they believe that 2026 prices is probably going to be in the mid-50s. So obviously that's going to be a haircut on their revenues going forwards as well. So going back to the balance sheet of what you would keep, you can't really assign an awful lot to their plant and equipment, really. If if the price of oil is going down and the demand is effectively dropping, which is why ChatGPT, I believe, has said only maybe 40 to 60%. Well, ChatGPT has estimated a liquidation value for this company. You got it here, total adjusted liquidation assets. So this is what they would recommend that you would change. Now, a lot of other people could disagree, and I hope you do, and I hope you inform me if you do disagree. I'm always trying to learn, because this is a new game to me. If you haven't seen my videos before, I don't know what I'm doing. I'm trying to do this and build a portfolio for the first time. So I'm just learning from everything that I can, and I found that ChatGPT is actually reasonably helpful for that. So if for anybody that's looking, this is the things from CIVI's balance sheet that ChatGPT recommends be discounted, and by how much. So once you've done all your discounting for liquidation value, all liability is taken at face value. Then on top of that, so here you go, net liquidation value, adjusted assets, total liabilities. They believe that it's only worth $2 to $18. That's quite a wide range, to be fair, isn't it? But you're talking almost 50% on their higher end. You're talking almost 50% below the market price currently for a liquidation value. Now, do I think that they're going to go, CIVI is going to go and have problems? No, I don't. Not anytime soon, anyway. When we look at, is this the right one? Yes. The thing that is worrying about CIVI is the amount of debt. Look at the difference between the enterprise value and the market cap. So that's 5.3 billion in debt. That's on top of that. Now, when we go on CIVI's notes to their financial statement and look at their long-term debt, they do have next year 400 million coming due. Now, I don't see that as a problem for them remotely. When we look at their simple free cash flow over the last few years, I think they'll be able to pay it. No problem, to be honest. That is my opinion. They don't have a lot of cash on their books, but they've then got until when is the next one? 2028 to pay off their next senior notes. Obviously, significantly more money there, for 1.3 billion. I take it. This is in thousands. There you go. So at 1.3 billion, significantly more. But again, if their simple free cash flows are staying in a similar area, then two and a bit years to find that money, 2.5 years to find that money, I don't really see it being too much of a problem for them. So yes, there is a significant debt on this company, but currently simple free cash flows appear to be covering it. Gross margin changes a lot. I don't believe that's probably something that's uncommon for this sort of industry. It's very cyclical, very all over the place. SG&A margin though has gone in the right direction. If this is correct, but that's definitely gone in the right direction. Cash flow from operations margin, so CFO margin, is very, reasonably consistent. The operating margin changes quite a lot, but then, what EBIT compared to free cash can be very different, obviously, because the depreciation that's put back in the free cash, it's money that's already been spent, so big difference there. So these is a 3-year average of the simple free cash flow margin. So if we're predicting that, there could be, what is it, 20-30% decline in 2026 on the revenues, then what are they, 4.8 at the moment? I've put in my net present value calculator, potential for 3.5 billion. So it's probably quite low, because I think, which one is it in? Is it in this conversation? So there you go. So I asked ChatGPT if they could give me some scenarios on what it would do to CIVI's revenues should the price of oil per barrel drop in significant, area. So the analysts believe it's going to be between $55 and $60 a barrel. So you are looking in this, 4 billion max range for revenues, if being conservative here. So I, to be even more conservative, obviously I've put 3.5 billion in. Now I've used the 3-year simple free cash flow margin and the 7-year simple free cash flow margin, that one there, and then so this 3-year average is further down here somewhere. There you go. You've got the 7-year average. That is 7. There you go, 11.9%. So all the way through, the simple free cash flow margin has actually been very good for this company. Not very good, but at least in the last 5 years, it's been positive and reasonably positive. So I'm reasonably comfortable with using these, and then obviously I've only used 20% going forward to be conservative. Now this is something that I've seen Keith Gill do when he was valuing GameStop. If you want to watch a decent video on how to actually value a company, he did an hour-long special of valuing GameStop, where he basically went through the book value and found what he thought was a fair net asset value, and then added his estimates of, I think he used 6 years of simple free cash flow discounted back to that net asset value, which is what I do here. So that's what I've got a Roaring Kitty value here. Now this is on top of tangible value, because I only like using tangible things when I do it for I don't really ascribe any value to goodwill or anything like that. Obviously, that's coming back with a significantly higher number. I don't really know how I feel about that, because I think it's too high, considering the fair net asset value for CIVI is not the same as a fair net asset value for a retailer. in that most retailers, their property, plant and equipment is carried at cost, so it's potentially, especially the property, worth more than what it's actually carried for on the balance sheet. I don't believe that's going to be the same with an oil driller, remotely the same. So it's possibly not a great way to value this. You're probably looking more at the Monish Purbright way, where you're just valuing it on cash flows and a multiple of cash flows, and the Joel Greenblatt way, where you are just working out a potential multiple for next year and seeing what it trades against now. So that is further down. So there's my Monish Purbright one here. I would sell it for a multiple of 10 in the future. Now that is potentially optimistic, considering simple free cash flow. The market cap recently has been significantly lower than that, but ChatGPT has informed me that the market average, I don't know which one it's in, is significantly higher. It's around about 13 for an oil company, I believe, price to free cash flow. Trading a multiple of about 13. I won't be able to find it. We're going to waste a video trying to look through it, but I'm sure it said 13 to 15. So, you know, the cash flows are reasonably good on this. The debt is a problem, but I believe there's enough cash flows to cover it in the long term after 2028. When's the next one due? 2030. So they've got time in between to sort out cash flows for these debts. Now, my only problem is how they're funding their debts. You know, historically they've been diluting the shareholder quite significantly, which I don't normally like to see. Now, there is a dividend per share, but the actual common dividend is only about $2, $2 over the last 12 months, but that's still at this price 6% dividend, which isn't bad, is it? You know, more than what you get in a bank, I guess. Interest rate, at least in the UK it is. I wouldn't know what the interest rate is in America, to be fair, but at least in the UK it is. So yeah, the Monish Purbright one, you know, 10%, 10 times multiple, discounted. Now, I don't really understand a lot about, well, I do understand discount rates, but I don't understand how you would choose a multiple based on your idea of the risk, on what your you know, I guess expected return is. Everything I've read from value investors, talking like Seth Klarman, Warren Buffett, from what I've heard Charlie Munger say, and what I believe from Joel Greenblatt's lectures is saying, is that they don't go any. Joel Greenblatt won't go below 6% discount rate, but from what I've read, they tend to go about 3% above the 10-year Treasury, which is where I've got mine from. My discount rates could be wrong. Please inform me if you use something different and why you use something different if you come across this video, because it will help me significantly. It's one of the parts that I'm still like, you know, I don't really understand people's required return is if you get a say in it. You know, it doesn't make too much sense to me. So all I want to know is that I can beat what is a given, you know, in the 10-year Treasury is as, you know, as given as you can get in the scheme of things. So I want to beat that, which is why my discount rate is slightly above that. But so if the average multiple is around about 13, and I'm ascribing 10 because the cash flows are pretty good, then the only thing in my mind that can be, I suppose, keeping this down is the fact that they're diluting the shareholder. These are pure guesses at this point, but I feel like they're semi-educated guesses in that they're diluting the shareholder, and people don't like that. I certainly don't like that. The oil industry is not looking particularly good for the next 12 months if the price of oil is expected to drop more. And obviously there's debt overhang on this company, but the debt overhang I don't believe is as big a problem as it looks. So on a simple free cash flow multiple, the future earnings, now this will be, have I described how we do it? Where does that come from? C6 times 36. Sorry, I should know this. I should put them in. So that's the 3-year simple free cash flow margin. I'm using 50% of it. So again, that's conservative when we know that the current one is 26 and I'm only using 50% of it going forward. So on the revenues of 3.5 billion, that's going to come back next year with simple free cash flow of 460 million, which a share is $5. And then obviously compared to the current price, that's a multiple of only 6. Now, if the overall peer multiples are on average trading at 10 to 13, then you would take an educated guess that this could be. Don't listen to anything I say because I don't know what I'm doing. This is absolutely not advice. This is just what I'm seeing, and I'm documenting what I'm seeing. It could potentially be undervalued on that metric, but saying that, at a multiple of 6, you are still looking at more than what it has traded at historically, like considerably more. What's the average over the last few years? A 5, So whether or not that is realistic for this company remains to be seen. Like, you'd have to err on the side of caution that it isn't, just because it's not traded anywhere near that high since 2021. It doesn't mean things can change. It doesn't mean things can't change. But that is sort of where I'm at on this, is in that could be, couldn't be. The Monish Pabrai one, so discounted the similar cash flow. So I'm using 50% again of the simple free cash flow margin. So that's exactly the same figure as what the Joel Greenblatt one is using. 50% of the simple free cash flow margin going forwards on less revenues. Taken 5 and 10 years into the future, discounted back the sum, and then add in a discounted selling the business for 10 times multiple in year X, which would be year 5, so it'd be 10 times multiple of that, and then a 10 times multiple of that, and then discounted back. Is that right? Monish Pabrai is saying that it's potentially undervalued as well from the Monish. This is from the Dando investor I got this from. So, this is definitely a head scratcher, this one. It's not one that I'm willing to make a call on, to be honest. Potentially one that I'm going to stick down to monitor and learn on, because there's definitely parts about CIVI that are interesting from an educational point of view for me. Yeah, like I said, the enterprise value is huge, and this dilution, I don't like at all. But the cash flow side of things look all right. The return on capital declined significantly, but still looks all right. Richard Pazina says a business has a higher return on capital, which is greater than its cost of capital. It's an indication it's a good business. Now, I'm not really someone that likes cost of capital, to be honest. I will use a cost of debt. What's the percentage potential percentage interest expense on debt? But when people are saying what is expected, because weighted average cost of capital is one part is the actual debt, and then one is like the expected shareholder return. It's like, well, I don't understand how you can do that. You're in the realms of fantasy then, expecting to, I expect this much of a return. Well, yeah, but it doesn't mean you're going to get it. So, I only use the cost of debt side of it. Now, I've got it as around 6.5%. So that is, there you go. That's the interest expense divided by total debt times 1 minus the tax rate. So at 6% and a return on capital of 9%, that's reasonable. It's not as good as what it was when it was 16%, and the return on capital was 19 and 25%. Not remotely as good, but it's still better than the cost of debt. So that's semi-reasonable, but yeah, I don't really know where I stand with this one, because obviously it looks great technically, but there's some things about this where I can see why it has been held down, you know, or is being held back. At least it has been. Well, you know, when did the decline start? In April 2024. So you're almost, we are 18 months ago. You know, we're coming towards the end of 2025 now, and you're still in this area. Now, like I said, this technical channel could be absolute bullshit. It almost certainly is, because there's no, there's not enough from a technical point of view to really try and do this. The only reason I've chosen this is the amount of times price has stalled in these regions. Yes, it's gone outside of it, but it's immediately come back in. And every time it's touched this, slight technical analysis lesson here, but every time it's touched this, there's been quite a reaction by the market away from it, you know, and then here significantly. And then when you've got down to the bottom, you know, what's that? Since March 2025, the price has refused to break below this ascending channel, you know. So from a technical point of view, I feel like there's potentially something in, at least in this bottom line. The reason why I've gone up to there as well is that there appears to be some justification around the midline of it. I'm going to sneeze, sorry. So whether or not technically this holds any weight, I don't know, but that is my reasoning for choosing that as a potential upward channel. Now, fuck me, don't invest on technicals. Just don't. I do it just to see where there's, you know, potential price floors, potentially where buyers could be, because I don't really know why, really. It seems a bit stupid considering I am a value investor and I only really care about the fundamentals, and here I am explaining technical analysis, but, you know, it is what it is. But yeah, so that's me on CIVI currently, in that I'm head scratching. I can see upsides and I can see downsides to it, you know. This book value growth appears to be all from acquisitions, though it's not organic, and that's not necessarily a good thing. Obviously you want organic growth, you want to know that the company's built, growing itself. So I'm always very wary on a company when the growth is not organic. I haven't actually seen what other people have stated about CIVI, so it could be interesting to look it up. But I feel like my cash flow estimates are reasonably conservative for the future. I could be wrong, you know, I could be really wrong on that. I am always certainly really wrong on that, so don't take any of it as certain. And like I said, almost certainly won't be investing in this, but I feel like my estimates are reasonably conservative, you know. When was the last time the simple free cash flow margin was under? So you're talking 2021, you know, so for the last 4 years, bear in mind this is a TTM analysis, you haven't had anything close to a 13% simple free cash flow margin. So, you know, I said I feel like they're reasonably conservative. I could be wrong, but yeah, that's where I'm at. If anybody's watching this and seeing, you know, that's my thoughts. This is me trying to learn, and that's what I've got with it, you know, on the assumption that oil will decline, because a lot of analysts are under the opinion that it's going to continue to decline. You know, they believe it's reasonably close to a floor, but again, I don't know how accurate you can be on that, because nobody knows what's going to happen tomorrow, let alone next year, you know. But that's where I'm at with it. But we've got quite a few people here that saying, oh, I'll tell you what, another thing I've noticed insider buying. My actual purchases, significant amounts, around about slightly lower than the current price. Now, that's what you want to see. Directors, CFO, CEO hasn't done anything for a while, but it's still $250,000. You know, it's not to be sniffed at. 875 million for the COO, not to be sniffed at. There appears to be some, you know, well, you know, that's what's that, a different person every time. So every single one of these looks like a different purchase. So, you know, they potentially believe it's undervalued. Whether or not that's just to fool the market, I don't know. But when you go on the insider ownership, there's only Kimmeridge Energy Management. They've got supposedly 100% of their portfolio in it. Everybody else is, 5% is not a small position. But they've also sold out a lot, and they first purchased in 2020, and the estimated price was higher than what it is now. So, there's no one else here that I overly respect, though. I've got a few hedge funds that I respect, and I will monitor in here. There's nothing really here from people that I've heard of or come across really before. So, there's that. The other thing I want to see actually before we go back to reading other reports is SEC CIVI. Let's have a look. Oh, it did not work like I wanted it to. SEC CIVI. There we go. I wanted to see insider ownership, what percentage it is, because obviously the higher the percentage, the more, the better it is for us, because that means that they are in lockstep with a shareholder, and if it hurts us, it will hurt them. So, beneficial. Let's have a look, see what we can come up with. Is this the right one? So, Vanguard, BlackRock, 10%, 9%. When it comes down here, then less than 1%. All of them hold less than 1% of the float all together. Is that all together or not? It's looking that way, isn't it? All current directors, yes, less than 1%, the one down the bottom. Not instilling you with confidence, is it, even though they've just semi-significantly recently. I like to see higher if I can see higher, but let's have a look at what other people are saying on CIVI. Trading just 6.1 to forward earnings, which is around about what I use. So they've come up with something similar to me there then, because what did I say? 6.5, so they're actually more conservative than I am. So I don't like that. I tend to like to be the most conservative person in the room, but there we go. Strong free cash flow, yes, I can see that. Disciplined capital allocation. Now, not entirely sure on that, but executing debt reduction. Now, yes, I have been told that by ChatGPT as well, and yes, I think they've taken 750 million potentially in share buybacks. They want to do from the free cash flow. I think it said they wanted to do 50% buybacks, 50% debt reduction. So, that's heading in the right direction, isn't it? That's no mean feat. That's it's nothing to be sniffed at. That's good. Business strength point of view, if they can do that. I mean, that would be spending all of their free cash, but I suppose seems a bit silly. But low valuation, solid fundamentals, and income potential make it an attractive value income play for long-term investors. Yes, well, that is what I am. I don't know if I've ever mentioned that before, but anything that I am looking at here, I want to hold for like a minimum of 3 years. Now, that's not a long-term investor really, but Monish Pabrai, Joel Greenblatts and all that basically said that, the market should agree with your thesis within that amount of time. Monish Pabrai said, like, when you get to 3 years, it's down to you. But I'm sure he said that he would likely be looking to, take one on the chin and say that he's potentially wrong from that point of view. But yeah, let's have a look. Beating down cyclical names can be great places for long-term investor gains. It's so long as the company is fiscally sound. So let's see what they say about this, because my inexperience is having me a bit and ahhing, over how sound they are. Decent dividend yield, trades far below valuation. My last piece, CIVI's delivered 20% total return, far outpacing 9% rise in the S&P. Yeah, well, that will be, I don't know when he wrote last, but Yeah, 22%. Say I'm guessing then he's wrote around about these bottoms, which is historic bottoms around here. Okay. Despite the recent run up, CIVI remains in the value range at the current price of 33.80. So he wrote this. When did he write? It must have been recently, September 11th, very recently. One of the largest independent oil and gas producers in the DJ and Permian Basin. Formed in 2021, CIVI has proven its resilience amidst lower commodity prices by reducing operating costs. Yes, we've shown that, didn't we? SG&A costs and all that have gone down. Meanwhile, CIVI delivered robust Q2 2020 oil volume growing over 6%. Operating costs declined by 10%, lovely, on a per unit basis. Came in at the low end of prior guidance, driven by lower well costs and faster drilling and completion cycle times. So I agree with that. If that is the case, then obviously the efficiency is going in the right direction. Sorry, just knocked something on the floor there. Again, strong efficiencies were realised in the Delaware Basin, drilled footage per 20% above plan. 8 wells averaging. So I have read all of this in my GPT stuff telling me about all this, but it's just taken me so long to scroll back through to find it. It's easier to read it again here from somewhere else. Even stronger second half. Yeah, I've read that. Average below $10. Getting the second half for it and accelerated efficiencies. Hedged its position with 6% of oil volumes locked in for 2025. This is twice its usual level and provides cash flow stability. Yeah, okay, that's good. Committed to reduce net debt to $4.5 billion by the end of this year. So, okay, fetching a strong 4x multiple, 2026 expected free cash flow. CIVI carries a sound net debt to TTM EBITDA ratio of 1.3, $2 in total liquidity. Okay. Yes, there you go. 50% of free cash flow to dividends towards share repurchases. So yeah, that's what I just mentioned. 375 million in buybacks this year. Now, it depends on whether or not they actually do them, I guess. It'd be nice if they did, because like I said, their share count has ballooned because of their acquisitions. CIVI's board increased its buyback authorization to 750 million, which equates to 25% of its current equity value. Equity market cap of 3 billion, yeah. 5.9% dividend yield. Yeah, so it's actually higher, like slightly higher than that now if you were to purchase now, but yeah. Well covered by 46% payout ratio, and share purchases are expected to save 20-25 million annually in dividend outflows. Interesting. Or PE1, which is far below much larger peers. There you go. So that, yeah, 16. That's what I said, wasn't it? Up to 20. Wow. Massive scale. Yeah, it deserves a lower PE. However, I view the current valuation gap as being excessive. CIVI would only need to deliver around 4% earnings per share growth annually to achieve market level returns. I believe this represents a very low bar. A combination of dividend share buybacks and volume growth positions for CIVI potential market beating total returns. Higher leverage, yeah. I said the enterprise value is quite high, isn't it, compared to the market cap? Higher interest rates, yeah. Or disruptions in the bond market could raise CIVI's cost of capital. I haven't actually checked the bond markets. We should have a look at that. See what they're. I can't imagine the bonds are trading too badly when compared to their free cash flows that they're earning and the time scale they've got to pay off stuff. I can't see them not being able to pay it currently. This could result in permitting delays and more costly compliance. Vested takeaway. Civitas remains an attractive value and income play, trading at 6.1 forward earnings for nearly 6% dividend yield, 20% total return since June, which is more than double the S&P's. Okay, interesting. is CIVI on here? Is this going to load? Here we go. So this is trying to find their Civitas resources. Date 2028. Yeah, there you go. See, they're all trading above par. I got a funny. They got quite good. Oh, not on the document anymore, are we? Is it going to load? They got quite good yields on them, haven't they? Notes table, long-term. Oh, not that one. This one here, long-term debt. Yeah, 5%, 8%, 8%, 9%. You know, so yeah, even on high yields, they're still trading above par. So the bond market believes that they're not going to struggle. You know, even out to the 2033s, trading above par. So the bond market's not pricing in any struggle in them being able to actually repay it. So this is a reasonably attractive position, this really, isn't it? Still don't take my word for it. God, no. Like I said, I still not of the mind that I would invest in it, but certainly one to watch from the learning point of view, you know? What's interesting, obviously, I suppose, from the learning point of view is that, high debt, shareholder dilution, but reasonable looking cash flows, you know? So, quite low on forward PEs, coming out very similar to that guy. You know, yeah, interesting one. See what someone else, because somebody else was a strong buy, weren't they? See why they are a strong buy as opposed to a buy. This fella here. Increase in production and free cash flow in the second half of 2025. The company plans to significantly delever. Yeah, we've talked about that now. Okay, very consistent, 60% debt and 40% equity. That's what they want, right? Near-term cash flows are protected by a very strong hedge book through 2025. I rate CIVI as a strong buy on the prospects of capital appreciation to go along with a 6% dividend. Yeah, seeing the same things as these people here, to be honest. Generally produce positive results across the E&P industry. Nonetheless, market still treats energy stocks as if they're out of favour investments. Yeah, that's what I said at the beginning when I was talking about you know, this is that they seem out of favour. Less than 3 times earnings, trades at less than 3 times earnings. Is he on about revenues? Possibly on about revenues, I would imagine. I'm not looking at the right one. I got another bloody spreadsheet open, but on a different screen. I'm looking at the wrong bloody one. So these are enterprise value multiples here, and these are market cap multiples here. Okay. I said it depends on what he means by earnings. If he's on about net income, have I got net income on here? I must have net income on it somewhere. Net cash flow, earnings, there you go, 11. Earnings there, 4. I've got it at, but, you know, that could be data differences, I guess. I generally like to do stuff against enterprise value where I can. I know some of these I've read that you shouldn't do, to be fair. Company plans to pay on 900 million in debt by year's end, so that's more than what the other guy's saying. It's also more than what I thought, but it'd be interesting to know where he got that data from. As in second quarter, I reported adjusted EBITDAX. Charlie Munger says when you read EBITDA, think bullshit. So, you know, free cash flow of 749 million, 123 million respectively. This is a very strong performance with EBITDA declining only 5% sequentially. What did we, I say we, because this will be White Sheet's data now. What did they take simple free cash flow as? Wrong one. Negative. Net cash from operating, and then so it's interesting to see where he's getting his second quarter free cash flow from. I've got it as positives over the trailing 12 months, but so it's a strong performance with EBITDA declining only 5%. You know, oil prices declined over $10 per barrel over the same period. Strong production growth, declining costs. We've pointed that out. Yeah, operating expenses and well development. The company continues to improve drilling and completion times, resulting in single-digit well cost declines across the portfolio. This allowed the company to report capital expenses at the very low end of the guidance range. Operating expenses also declined significantly. Okay. Spending a lot of time on a single business again now, aren't we? Exposure to commodity declines mitigated through the company's strong hedging profile. Okay, so that's the second person to mention that. Entering Q2, roughly 50% of the company's oil production was hedged above $67 per barrel. That's good. Helped to minimise much of the downside. Okay, let's have a look at its valuation then. As I discussed my thesis, CIVI exhibits a very cheap valuation, trading under 3 times EBITDA. This is a full turn lower than peers, Devon, PR, and slightly higher than, okay. Also stands out as an outlier for its large yield, but also its elevated leverage ratio. Yes, this is what we talk about. Leverage ratio is quite high. Due to the company's high debt load, CIVI carries twice the leverage ratio than that of its peers. This is the primary reason for its stock's cheap valuation. Yeah, so that's what I suspected as well. As the market has become even more risk averse in light of decline in oil prices. Yes, again, another thing that I attribute it to. Most would consider its debt load as a huge weakness for the company at the face value. They would be correct. However, it also represents an opportunity for significant capital gains if this weakness is eliminated. Yes. Plot the enterprise value of each company as a pie graph. The proportion of debt and equity comprises each business. Where's this? Oh, down here. Okay. First thing that jumps out is how around 2/3 of CIVI's enterprise value is debt. The company had $5.32 billion in debt at the end of Q2, stated goal driving it down to 4.5. Company expects to do this through free cash flow, and yeah, okay, we've said that. Assuming the company is successful in this effort, it equates to around 10% of total enterprise value. Yeah, so, I mean, that does look bad, doesn't it, compared to the peers that he's used. Since the investment community is debt averse, the decline in enterprise value isn't a very likely outcome. Therefore, we'll focus on flat EV for the purposes of this discussion. In a flat EV scenario, the size of the pie stays the same. However, the blue slice of what is potentially the share price must expand and accommodate the void created by reduced debt. In a very simplistic view, the market cap of the company must expand by 24% just to keep the overall valuation of the company flat. Okay. Right. This situation is unique to CIVI because its financial composition is so vastly different from many of its peers. Take for an example of Devon, who plans to retire $2 billion in net debt, again in flat EV. Okay. This thought process is hammered on a bit by analysts during the Q2 conference call. Funds from the company's share buyback program would be of higher value if they used to retire even more debt. Yeah. I mean, I'm always for that. High debt companies are the ones that aren't destined to last, you know. Then let's go back to sort of Zach's question on the strategy shift with stock buybacks. I'm going to pull the question to you, why not push net debt further, right? Down further. I mean, I've been doing this almost 30 years. Okay, stock price will fix itself versus trying to force a stock price issue today. Yes, I agree. If you get rid of the debt, the stock price will fix itself. Management team never really answered this question. So who's he from? Did he say he's from? RBC Capital Management. Where are they? How much do they own? Aren't even here. Doesn't look like it. I mean, look how many people are in this. It's a lot, isn't it? Ownership. It doesn't appear like they're on this first page anyway. Oh, Royal Bank of Canada, is that one that's going to be RBC? Possibly. I don't know, to be honest. It would make sense, wouldn't it? Improve free cash flow outlook. Managing free cash flow remains critical to paying down debt and returning cash to shareholders. Is expected to be materially higher, while capex spending should be materially lower. So he's going for increased free cash flow. Interesting. Whereas I'm generally of a, I don't really want to factor in growth thing, and that could obviously hit me significantly. I could miss out on a lot of opportunities from that, I suppose, and time will tell whether or not I'm doing the right thing. But I try not to analyze as if growth is a potential given, you know. At best, I analyze as if things won't get worse. Generally, I analyze as if things are going to get worse, though. Even if commodity prices weaken from where the company has been extremely proactive in hedging the portfolio. In addition, the company has also put favourable prices on its natural gas production as well. Okay. Doesn't actually look like he gives a price, though, does he? Managing the debt load remains critical to CIVI. Yes, it's obviously has a high amount of leverage, but the interest rates on the company's debt make the issue even more important. Yes, because we said they were high. Look, we just showed that they were high by looking at the notes on the balance sheet. Accrues at 3.7 billion of the company's debt. That's an interest rate greater than 8%. Yeah, interest expense of 114 million. So yes, if you paid down some of that, that would make a significant difference to free cash flow. While the company has strong hedges through, the company may be unable to replicate this in 2026 if commodity prices continue to deteriorate, which is what we are saying that they will do. Analysts are saying that they would do, not me, but such a scenario would result in a significant decline in free cash flow and the inability to pay back debt as currently projected. This would likely derail my strong buy recommendation with the potential for share price decline. Yeah. Interesting. Do I have... Where are we here? Interest expense, yeah. If this is a correct number, because his says it's different, doesn't it? Oh no, it says not, it's probably correct. 400 million is probably correct. 140 million in Q2, 10% of total revenue. So what were the... Let's just check this. Open up. Yeah, billion in revenues. Interest expense, yeah. Okay, my data is slightly different, but you just need to be in the same ballpark, you know. Interesting. So there's people thinking there's some upside to this, that's for sure. That is for sure. I've put some comps in, but I don't really know if they're EV to sales 2.3, 1.8, price to book. See, these are EBIT to EV. It ain't too far out, is it? So from that point of view, it's not really undervalued. I suppose against the big boys, these are, I believe, similarly sized companies, market cap wise. Yes, they are. So yes, if you're taking it against the big boys, it probably is low. But against like-minded sized companies, EBIT multiple to market cap 4. That's a difference, mine. Although this SSM is still quite low. Gross margin average 3 years 47%, 47%. So they're around about the same. Operating margin 43, 42, 38, 47. So it's better. Operating margin. Simple free cash flow margin average significantly better. Significantly better. Interesting. That's against EV as well. Interesting. That is interesting. Return on capital. Simple free cash flow 11, 1, 1, 6. Significantly better as well there. Interest coverage better than 2 out of the 3. None of them run a positive current ratio, but they could be creating so much cash it doesn't really matter. yeah, debt load, debt to capitalization. The debt load obviously higher than the peers as well. Interesting, definitely interesting, this one as a you know, as a one to watch for sure. For sure, I'm going to put a blue tag on this, and we spent an hour on CIVI. Jesus, what have we got next? Wimmy hologram, cloud ink. Looking for right. My quick take one. What is this? Wimmy. Don't really like this cloud type stuff normally. Oh dear, that looks terrible. Simple free cash flow, however, positive. We do augmented reality based holographic services, products in China, and not interested. Genk, what is Genk? Genk Restaurant Group now. Oof. That's pretty tragic, doesn't it? Genk. Negative free cash flow, negative earnings, negative free cash flow. 2 years ago it was alright. Market cap of 104 million, enterprise value. Typical for a restaurant business. It's not something like McDonald's. Capital negative. Is it really worth our time? Not really. Nobody's overly bothered. Look at that. Tell me there's no manipulation in this. Say, wait. Opal Fuels, another one. Another potential oil company here. Negative free cash flows, negative free cash flows, negative free cash flows all the way back. Operating income slightly positive. What are they? The renewable gas. Duty trucking fleets. Okay, not interested. Looks terrible. Xerox. Isn't that one that's fallen from grace over the years? What's this? The .com crash up here. It's history like in price charts. Boom. Jeez. 90% of its value. 90% of its value. There we go. And we're obviously way below that now. What's Xerox going to show us then? XRX. Interesting. So why is this so hammered when positive? This, I would imagine. Should we bring this one up? I think we should bring this one up. I mean, it looks so awful. Why wouldn't we as a value investor bring up something that, you know, didn't look awful? Let's have a go. And do you know what I'm going to do? I'm going to open, because I've saved several now of these. I'm going to open another one. Where are we? Oh, sorry, I'm looking in the wrong place. That's why you can't see this. It's off screen, but here we go. Is this one empty or not? Or is this one still got Crocs in it? Okay. We can get rid of that. XRX. Okay, get rid of this. Get rid of this. Get rid of this. Open up Y sheets, quarterly data. XRX, Xerox holding. Let's drag it in. Close this. And now do the obligatory unprofessional copy and paste. Right. See what we're seeing. Book value $10 a share, tangible book value negative. So why is that? Have we got goodwill and intangible assets? Significant amount of goodwill. Quarter of the balance sheet, close to quarter, so not the balance sheet of the total assets. Short-term debt 458 million, cash almost covers it. Long-term debt 3.4 billion. Okay. What are we saying? Simple free cash flow is a year. Let's just have a look. I don't know when this debt's due, minus another thing. It's, you know, what's it been positive since 2019? Interesting. Doesn't mean that I suppose that the company has good future prospects, but I don't even really know what Xerox does. I know the name. Photocopying and stuff originally, wasn't it? I think, I don't know. Dividends. Are you kidding me? Is that legit? 25% dividend? More than 30%? Where would we be? What's this? December 25. 12 and a half. Let's get the old graphic calculator and add this up. 0.25 plus 0.125 plus 0.025, and getting less and less, plus 0.25. So no. What was that saying it was? 42 I've got there. What was that saying it was? Dollar. It ain't that much. 42 cents I've got. 42 cents divided by 3.77, 0.42 divided by 3.77. I mean, that's an 11% dividend yield. That's pretty good. Sorry, I've just got Denver, Indianapolis on the TV. I'm just turning around because I'm a Broncos fan and Indianapolis seem very happy at the moment, so I was just seeing what's going on. What have we got here? Can Xerox step back from the brink? Let's ask what Xerox does, shall we? Explain XRX business model, how it generates money, its geography. What else do I want to know? How it generates money, its geography. Oh, and its revenue breakdown. Knew there's one more. Come on. Now let's put on some pictures. Okay, Xerox has undergone a significant transformation from its traditional, there you go, photocopier business. That's from Frenzy. The diversified technology and services company. Its business model focuses on two primary segments: design, development, and sale of document system solutions and services. Provides financial solutions for direct channel customers, purchases of Xerox equipment and solutions, as well as lease financing. It doesn't really explain what it does. Print another 5.86 billion. That's obviously the majority of their stuff then. By geography, 3 billion in the United States. So what have they got then? How many revenue? What's their revenues? 6 billion in revenues, and it's trading at 462 million. This is obviously a huge reason for that, I would imagine. bolster its position in the global market, Xerox has undertaken strategic acquisitions. Lexmark announces aiming to enhance its core print portfolio and expand its managed print services. Xerox acquired CIVI to expand its IT services business. Financial performance: revenue 1.5 billion, a decrease of 7.5% year over year. Operating income improved year over year, 110 basis point increase. Okay, I'm still looking at the wrong bloody screen. Xerox Holdings Corporation is evolving from its legacy as a photocopy manufacturer to a comprehensive technology and services provider. Can you expand upon point one print another? Ooh. You tell I'm not American, because I'm guessing anybody from America probably know this. Segment includes designs, manufactures and sales, multifunction printers, production printers, office printers. Okay, supplies, consumables. Okay, and so it is actually quite a simple business. Services, customers' print environment, optimizes printer usages, reduces costs. Okay. Solutions, enables. Okay. Supplies and managed services. Okay, I want to know that. Okay. Supplies and managed services form a large part of recurring revenue. How much of their revenues would you estimate to be recurring? Historically, this has been the largest recurring component, 40% 50% of print and other revenue. Really? Okay. Total recurring revenue estimate of around 5 billion. Well, you don't. What if they made 6 billion? Really? When was that? 2023? Or did they mention 7.1 billion? 7.7 billion. 65 to 70% of Xerox total revenue is recurring. Really? That is interesting. If ChatGPT is correct. Has anyone on Value Investors Club, if I'm still signed in? Xerox, I'm probably not still signed in. Yeah, sign me out, I'd imagine. Okay, doesn't matter. Alright. SEC. Thank you. Financial statements. First off, balance sheet. Current assets, inventories, finance receivables, accounts receivables, 450 million in cash on the books. Total assets. Don't like that I said, don't like that. Tangible value is negative, isn't it? I'm sure we still. Yeah, 6.8. Interesting. Long-term debt, 3.4 billion. Accrued compensation and benefits costs. What's this? Accrued salaries, bonuses. Okay. Convertible preferred. Great. Retained earnings down slightly. Dear, it looks like Denver's going to lose. I should be focusing on this. Don't get distracted. Okay. Land and buildings and equipment, 187 million. Equipment on operating leases, 249 million. what we saying the return on capital is on like Joel Greenblatts? Not high. And the cost of debt is still higher than the cost of debt though. Just. Simple free cash flow return on capital is significantly higher than the cost of debt, more than double. So this one's done off an EBIT, this one's done off a simple free cash flow. Book value's declined a lot. What has caused that on the balance sheet? Write downs there. Look at that, all that goodwill gone. 10 billion in goodwill. 11. I don't want to go further. That's no, 11 billion in goodwill. 12. There you go. Hit 12. 12 billion in goodwill. Wrote off. 10 billion in goodwill. Wrote off. Oh. Does that sort of scream bad acquisition or what? Well, not a bad acquisition, but you've overpaid. $70 in assets a share. Net current assets, there we go, that's the problem though. Got cash on the books of $3.57 a share. At $3.68. When's this debt due? We were looking at the balance sheet. Notes to financial statement. We got inventories, debt, here we go. Oh, you bastards, writing it all out like that. I prefer tables. Now it makes it more complicated by a mile. So can we skip it and see what's on here? Xerox. Yes, there's loads. Oof. 2039's 50. I mean, that's a long way away, to be fair. 2021's gone, 2024 is gone, 2027 doesn't seem to have anything on, 2035's 47, 2030's 100. Is this the right one? Still Xerox, yeah. That's interesting that the 2030s, 4 years time, still trading at par. Although some of these aren't. 2028's trading at 62. What's the difference between Xerox Corp and Xerox Holdings? Let's have a look. Subsidiary under Xerox Holdings, okay. And they got their own debt. Xerox Corp. Now that's interesting. Isn't it? Xerox Corp holds traded Xerox Corp holds traded debt. Is the parent liable for any of it? Xerox Holding issues bonds, the parent itself is liable. Yes, that's what I'm asking. I'm asking if Xerox Corp issue bonds and borrow money in its own name legally, it's the obliger, meaning the subsidiary is primarily liable for repayment, generally not automatically liable for this debt unless it's explicitly guaranteed it. How would I find this out? Who guaranteed? How do I find out who guaranteed? Who guaranteed Xerox Corp debt? What are we saying? Yeah, we're just lost. Yeah, so I gotta read. All right, can we? You know what? I will read this. I'll do it at lunchtime tomorrow on break because this could be an interesting one, couldn't it? It's trading in the absolute gutter, and yet it's got simple free cash flows are close to market cap. So it's obviously a potential long-term belief in whether or not the company's going to survive, you know, relevancy, I would imagine. And the debt, clearly significant. Shrinking book value as well, which doesn't help. Then obviously that's because they've got rid of a lot of the goodwill. I will pause this video here. I will go away on my break tomorrow and see what of this I can pull out. The states who guarantees 7 of them. Okay, I'm not gonna do it now, but we'll go away and we'll try and see what I can find out on break on who the guarantor is for some of this debt, because if it's not the holding company, then you might be able to remove some of it. I think that's probably optimistic thinking, but definitely worth looking into who the guarantor actually is. All right, I'll pause this. You won't even notice because I'll just continue, the video will just continue, but I will pause this and I will pick this up tomorrow after I've read that, after I've read the debt part of it, because that is significant. But it could also be room for major misunderstanding in how people value it, if there is any misunderstanding. Let's just have a look before I go. Who holds it? Xerox Holdings. Does anybody we respect hold it? So first off, no. 8%, 12%, Darwin Deason, whoever he is. I want this anyway. This is a more important thing to me. Mork Capital. Who is Mork Capital? Doesn't say. Okay, nothing of significance I can see there unless I'm overlooking something. We'll just look at the insider buying quickly before I head off. Definitely got some. I'm not going to watch that video, but definitely got some. Look, halfway through this year. Smallish amounts, but CFO, Director, COO, CEO, higher than where we are now as well. Definitely one to look into this, I think. This will be one I will pick up on tomorrow. You'll see me in a minute. Right, we're back. You're not going to believe what's just happened. I just tried to record loads of stuff. Probably got about 15 minutes into it and then realised I hadn't pressed the record button. So that was pretty effing stupid on my part. What I was saying previously is I noticed that car icon sold out, interestingly, at a significantly higher price. So he's obviously done the right thing there, but I do wonder how much he lost overall. What I said I was going to do at work today was look into the debt, wasn't it? Now, I've been looking into the debt. whilst I've been on this computer and we've not been recording it, so we're going to play a little bit of catch up. But what I did, which I think ChatGPT is very good for, is I just copied and pasted this whole spiel into ChatGPT and I asked it to break it down in simple terms for me. Now, what we were trying to find out is who the guarantor was for the debt, because obviously if the Xerox Corporation subsidiary was the guarantor, then my understanding is that that would not come back on or that debt could not come back on the holding company. So you couldn't, well, could you? I think Joel Greenblatts does in his post Marriott trade. If they're not the guarantor, then that debt is not. Yes, all right, it's a problem, but it's not as big a problem as if it was. If the corporation subsidiary is the guarantor, it's not as big a problem as the holding company being the guarantor, the parent. But the parent is the guarantor by the look of it. In breaking this down, now, one thing I noticed, which I've already, thinking I was recording, talked about further down in this conversation, is that they went from paying 5% to 10.5%, which is a huge increase to pay off their 2025 notes. Now, these aren't due till 2030, so 10% yield to have to pay for the next 5 years is significant. They've got others as well that 13.5%, big again, problem, effectively a problem. Now, what I did, because what I did was I noticed obviously that these notes were only started in 2025, and it is confirmed by going actually on to the said bond 10.25%, all on the thing, and they started earlier on this year. So my way of thinking is that the full interest expense impact is not shown yet currently, because we haven't had a full year of this. So I asked ChatGPT to estimate what the interest expense impact is going to be on the fact that they've now got significantly higher yields to pay on debt. Where did I do this here? There you go. What will be so I said, can you tell me what the interest expense? I can probably work it out myself, but we're going to get ChatGPT to do it because it's just faster, and we're trying to do things as fast as we can, really, because it's just me. I need to analyze as much as I can as fast as I can. So this is where ChatGPT has been very helpful. So on the old notes, there we go. So currently we'll start with the new notes. The annual interest rate on the 10.5 they reckon will be 41 million, and then on the second lien notes they reckon it will be 67.5, so that's 108.5 million. Doesn't seem too bad that on its own. It's estimating that it was only 28.5 million of annual interest before for these for two of the notes that they've paid off. Now they've got other existing debt here as well. So ChatGPT is estimating, annual interest expense on it, and effectively what we've come to is that the annual interest expense now could be as high as 234 million. Now, if we look at what my estimates of free cash flow and TTM are, 292 million. It really does not leave you a lot of leeway if things were to deteriorate and go south. Now, that's a problem. Your company will be gone effectively. You're going to break your debt covenants. They're going to be calling it back in. It's not a good place to be. Now, revenues have obviously declined year on year on year on year. Your book values decline year on year on year. Intangible book values declined. you know, like the efficiency of the company has dropped as well, and your simple free cash flow margin has dropped slightly. Although there was a period there it was higher, but that looks like an outlier. Doesn't it? Looks like something, a 1 year thing, something that's potentially in that that's spiked that. So I wouldn't say that that's normalised, and these are still 3-year averages anyway. But yeah, it looks like a problem. I got to be honest, this debt looks like it could be a huge problem for them. Now, they obviously purchased Lexmark, didn't they? So there we go. Look, ChatGPT saying that there's an extra 74 million in interest expense per year. So I asked if they've given any future revenue guidance, and they have. And obviously they expect revenue growth of 16 to 17%, which is huge. Now that is because 1 billion of Lexmark revenue has gone into that. Now that's since the acquisition. So I believe, and I've asked, is that 1 billion for 6 months of Lexmark on the books, or will Lexmark add 1 billion? I was meant to say annually. So they're suggesting it's only this 1 billion is just from the 6 months now. So that is suggesting it's going to add 2 billion annually. I've asked if we know anything about what the earnings were, and it does look like it would be around 2 billion annually. And Lexmark's earnings went up significantly. You know, last year from 23 to 24. Net earnings were a loss though. And it said, you know, I asked about if they could, would we know anything about the free cash flow and the earnings. Now they said that they don't know anything about the free. ChatGPT said it doesn't know anything about the free cash flow. So I just said, is there any way you can find the statement? So operating activities, then a bunch of add backs. Here's what I found for Lexmark's statement of cash flows for the year ended December 31st, 2024. Cash flow section minus net loss. I want to see the link in the cash flow statement shows the above, but I cannot locate in a summary of more detailed line items. If you've got a link for that cash flow statement. Oh. It's whether or not Lexmark can help them, because at the moment you're not going to take much of a negative change in free cash flow, and you are in serious trouble. They are in serious trouble, and when you look at the price of the stock, obviously the overall market agrees. You know, it's been going down for a long time, hasn't it? You know, what was that? Highs of 52 in 2007. That's a long time ago. Okay, this is not the business that it was back then. It's struggling, and this debt, I think at 10%, but if 234 million interest expense, really, you could probably just stop looking here. To be honest, I think a lot of other investors would just see that about the debt and be like, no, that's it, we're done, we're not looking at this anymore. But this is very difficult, right? Because I want to get on and I want to build a portfolio, but I also need to learn. So I'm spending a lot more time. You know, some of my videos on a lot of stuff, almost everything that we've looked at, I've said no to, haven't we? If you've watched any of my previous videos, and yeah, I've still spent like an hour on it, which is obviously something that you hear a lot of the big investors not doing. But in my defense, I'm doing it as like a learning experience. So, you know, it's knowledge that I can come back to, you know, and draw on in the future. So it is wasted time in the sense that we're not building a portfolio because I'm wasting time on a company that I know I'm going to say no to, but it's also my education that's there, you know. Is there a link for the cash flow statement of Lexmark position? I want to know why they had a net loss. Here it is. Okay. Nice. When was this? 2024 annual report. Nice. Where are we here? That's the income statement, yeah. Where? So how many assets did they take on? What sort of like book value have they taken on? I'm guessing that would already be in their statements, though, already incorporated into their statements. I mean, they had $1 billion in goodwill themselves. So how much has the goodwill of Xerox changed in that time? Goodwill and intangibles, yeah, hasn't it still gone down? Interesting. Let's just ask, is the impact of the Lexmark purchase already apparent in the Xerox balance sheet? Yes, there are signals for Xerox find out that Lexmark acquisition is starting to show up in the balance sheet, but with caveats. Pro forma balance sheet. The balance sheet post-acquisition starts to show the actual impact: higher debt, newly acquired assets, goodwill. Financial statements. Let's actually have a look at where do we want this one? So, but goodwill's not really changed, which is interesting. Total assets have gone up by like 500 million. Short-term debt is down. Long-term debt is up. I don't actually know what they paid for it. What did they pay for Xerox? Oh, no, it wasn't for Lexmark. 1.5 billion, inclusive of net debt and assumed liabilities. Okay. Right, where were we anyway? We were trying to look at this. I want to find the cash flow statement, see if we can figure out, because they're saying they can't. Net cash flow from operating activities is 18 million minus 22. So yes, negative. I mean, it's all very well taken on the revenues, but if the, simple free cash flow margin is not there, is it a good acquisition? I just feel like we're on to a loser here. I'm not sure there's much that's... Can Xerox step back from the brink? Interested. Let's see what they're saying. Former tech star has come into hard times as its main print equipment business has been in a decade-long secular decline. Industry faces decreased revenues, consolidation, workforce reduction, and adapt their offerings. Still, does it say anything? Lexmark acquisition. Let's see what they're saying about that. I just want to know if they've mentioned debt. Xerox acquired Lexmark International for 1.5 billion consolidated. I could have just fucking read this instead of... I'm always a bit weary about what you ask because you're using up questions on ChatGPT. You only get a certain amount for free. It's just easier to ask, isn't it? Because generally my experience is that the data is accurate on ChatGPT. It's my experience anyway. 1.5 consolidating two large players in the global print and managed print services industry to expand their market leadership and innovation capacity. Included in Lexmark's net debt and assumed liabilities and was financed by Xerox through a combination of cash in hand and debt financing. The purchase brings together Xerox's legacy in the office photocopiers and managed print services, Lexmark's strengths. The acquisition is expected to drive significant competitive advantages, solidify its leadership, enhance capabilities for workplace transformation, marketing strength. Xerox now ranks among the top 5 in every major print segment and leads in managed print services globally. If they survive, the combined entity offers more comprehensive suite of geographic reach. New organisation gains significant manufacturing distribution reach, operating 125 facilities across 16 countries. Expects 200 million in cost synergies with accretive impact to earnings and free cash flow immediately, and a reduction in its debt leverage ratio to 3x over the medium term. Interesting, because this does not show. What is there anything in here then? There we go. No, because that's added back in, isn't it? So goodwill impairment's added back in. Depreciation's added back in. So what's come out of this? Accounts payable. Trade name impairment added back in. This is all stuff that'd be taken out in here, is it not? Trade name impairment, there you go. Goodwill impairment. So what has buggered them up on their earnings then? It's not great, is it? Because like I said, purchase property, plant and equipment of 22 million and you've only made 18.8. It's a balance sheet. 100 million, 189 million the year before. Net changing cash, plus 81 million, down to minus 91. Oh, they're saying here they've got 200 more. Receipts from debt. Sorry, 80 million more, not 200 million more. How are they seeing this then? Overall business strategy, transfer, AI driven, yeah. At the moment, I'm concerned about this. Took an additional debt to acquire Lexmark, an initial 1.5 billion deal with a combination of cash on hand and committed debt financing, including the issuance of 800 million in senior secured notes specifically to support the acquisition and repay Lexmark's outstanding debt. This financing substantially increased Xerox's total debt burden. The company says that while Lexmark acquisition was funded primarily with debt, results in a lower gross debt leverage ratio after accounting for nearly 300 million of Lexmark's acquired EBITDA. Yeah, but EBITDA doesn't mean shit. As of July 25, Xerox carried a total debt of 4.3 billion, of which 1.6 billion was finance-related debt. Management positions a core debt to adjusted EBITDA to manageable at 3x, but emphasise that bringing down debt further is a key priority in the near future. Debt maturity appears to be well spread out over the next 14 years. Yeah, it does, but you've got to pay the interest. Free cash flow and guidance. Free cash flow per share has been consistent over the last 5 years, even though the stock price has cratered. Yeah, that I would semi-agree with. Here, it's had some big ups and downs, but yeah, it's always been positive, let's put it that way, at least over the last few years. So that's positive. Management is guiding towards 250 million free cash for 2025 and 400 in 2026. So they got to get through 1 year. In the last quarter, there's been a spate of insider buying of Xerox stock, including my CEO. This is a good sign, agreed. In addition, guru investors are adding to their Xerox holdings. I mean, it is cheap. Xerox is attempting to grow its IT services business while trying to manage the cash flow generated from its print business. Right. Where's Gotham on it? Because it's all very well saying they're adding, but they don't hold. Where are we? Center portfolio. Like I say, it's all very well selling and saying they're adding, but if they're not adding anything significant, the fact that we're down into 0.01% me suggests that there you go, Gotham added 207,000 shares. Alright, a significant increase, I will give that, right? But their portfolio is nothing. That's what's this one here? They own 0.18% of the company. This to me just says like, oh, we've added more to our I can't remember what we call it now, but that's not Gotham buying a position. Like Gotham would have bought a position, you know, in Host Marriott or something. It's all very well saying these people are buying in, but look at this. There's no confidence in any of it. Steve Cohen's, is that the Sack Capital guy? Isn't Bobby Axelrod based on him from Billions? Great TV show, by the way. You know, it's all very well saying that, but I'm not convinced by that when the position size is that big. You know, it doesn't seem like a lot to me. Where were we? Xerox is attempting to grow its IT services business while trying to manage the cash flow generated from its print business to reduce debt. Stock market views the acquisition unfavourably, and since the deal's announcement has driven Xerox's stock price to an all-time low. Well, if they got 234 million in interest expense coming off of this, and they're only making like 200 and what did they say expected to be this year? 250. Oh, is there any reason why you're not giving yourself any margin there? Right. Sneeze a minute. Market is looking at Xerox at almost glass almost empty. Yeah, I can see why. I think it's more like a glass half full, and the company's fighting chance to recover. Glass half full thesis is as follows: printing may be in secular decline, but it is a long tail, and Xerox has the opportunity to grow its IT services. Guru focuses valuation chart below hints at value Xerox stock as if the balance sheet gets fixed over the next few years. Yeah, but really? Also, Xerox as the equity portion of its capital structure will start to grow at an increasing pace. Yes, I agree with that. Leverage will play into your hands. The uncertainty of all this happening, is high. Therefore, Xerox equity is a high risk, high reward bet. You really think that they're going to get 400 million in a year? Almost double it. I would suggest that's. I don't know. I've not read the data where they're saying that, to be fair. Free cash flow guidance for 2026. This is that bloke saying that they have it. So where? Couldn't find any clear for 2026. Let's read this, because they're saying you could be looking in the 60s. Obviously, that's way more than they're saying, so we would not use this at all. What is known? Xerox's guidance for free cash flow is about 250 million. They mentioned 2026 free cash should benefit from about 400 million of cash from a reduction in finance receivables. Also, their 2025 free cash flow guidance builds in certain one-time items that won't all reoccur in the same way in 2026. Yeah, okay. Start the free cash flow 250 million, including headwinds. Adding 400 million cash benefit from the expected reduction in finance receivables. Subtract out items that are likely one-off. Oh, really? Oh, that's just making it harder, isn't it? High risk, high reward. I gotta be honest, I don't know what the finance receivables are. What are finance receivables? Money owed to a company by customers who finance their purchases through the company. So is that 400 million coming from Lexmark then, is it? Run out of fucking questions now, look. 100 million reduction in finance receivables. They plan to monetize them, boosting cash on hand. Xerox specific, a big chunk of Xerox's business is selling printers, copies, and money. Customers rarely pay cash. Yeah, okay. Sets up lease or financing. Those payments are the finance receivables. Right. Xerox sells a 100k system. Customer pays for 5 years. Books receivable for future payments owed. These receivables tie up cash because Xerox has effectively loaned out the machine. If Xerox sells or securitizes those receivables, that's why management says 26 it will benefit from 400 million reduction in finance receivable. They plan to monetize them, boosting cash on hand. How do you monetize that then? You didn't show me that. We'll just have a look. Finance receivables there. Oh. Can I ask? Continue asking or not? How will they size finance receivables? That's right. It's obviously just dropped me down onto the non-chat GPT-5. Monetize finance receivables in a few standard ways using the equipment leasing. Pull a set of receivables and sell them as securities to investors. Investors buy the cash flows from those payments, giving Xerox immediate cash up front. This is a common way for companies with predictable lease payments to raise cash without taking on new debt. Xerox has 100 million in receivables. They package these into a security, sell to investors and get 98 million cash today. Okay. Investors collect monthly payments from a customer. Sale directly sell receivables to a bank or financial institution. The buyer assumes the risk of collection, gets immediate cash. Right, okay. A form of short-term sale where Xerox sells receivables as a discount to get cash quickly. So that's obviously what they're going to do then, are they? This is what this man's saying as well. Was in here somewhere, wasn't it? Free cash flow. Doesn't say it specifically, but is that not a one-time benefit? Oh, capital IS shouting at ChatGPT. Is that not a one-time benefit, though? You can't do that every year. Usually a one-time or episodic benefit, not recurring. It depends what they do, doesn't it, with that? It depends what they do. If we can get back up to the debt portion, would they sell... right, where are we at? 400 million at 10%, 500 million at 13%. It depends what they do with that, if they could knock off the debt. Say what they would use the 400 million. What do you call it? Monetization. Is it debt reduction? Not explicitly stated how it will use 400 million. However, based on historical practices and financial strategies, it's reasonable to infer that a significant portion of this will likely be directed toward debt reduction. Oh, there's a lot of guesses on this, but there it is. I mean, say you got rid of, where are we at? Say you used 400 million and got rid of 250 million of that, you're taking, you know, half your... This is the big one, isn't it? I think when it goes down here, that's the big one. Because that's only 5%. You need to get rid of stuff that's at the... Let's just have a look. It's still a big what if, isn't it? At the end of the day, it's still a big what if. 400 million would be a one-time benefit. They'd have to whack it all onto debt reduction to be in with a chance of survival. In my opinion, I don't know a lot. I don't know a lot, you know, but even then, you still got 3.5 billion. Yeah, this would be a hell of a gamble. The market doesn't believe they're going to do it, does it? Based on this, what were the bond prices at? Where is the balance sheet on it? Trade receivables is not a lot. Oh yeah, is there? Dear me. Last trade price 102, really? I was confident that they can pay it. Maturity dates, find the maturity dates, the long-term ones. 30s, 31s, 39s, 35s, 26s. It's the 13% ones up there. 99. Oh, dearie me. There's a lot to gamble on this one. Let's just have a look right at what a... What have we got here? 80% of that. What is their revenues? They state what their revenues were going to be. They reckon it's going to be $1 billion higher, didn't they? I asked that. I did ask that. I know I asked that. Any future revenue guidance? They reckon it's going to go up by $1 billion. Oh. All right. By $1 billion. Let's just do 6.8. I know they're saying $1 billion, but future simple free cash flow 372, and that is on a right. Say they get. All right, let's just see. Say they get 50% of that, 232. They're out. They're out. Can't afford the interest payment for that year. Probably can if they dip into the cash that they've got. Oh. It's just too risky, innit? They've given revenue guidance, have they? But have I asked about free cash flow guidance? I did, didn't I? I'm sure I did. That's how we came up with that 400 million of the monetization. There we go, yeah. 250 million. Pardon me. They're gambling. It's a gamble. Is it one with significant upside? you're still going to have huge debts. Xerox didn't have positive free cash flow. Oh, dearie me. This, the way we've got to look at it, right? If we want to be a successful value investor, it's the fact that we have to and ah over it is a no. Right? Has to be. But it's just an interesting one, isn't it? You know? It is interesting. I would like to see how this one plays out. In a couple of years' time, it'd be interesting to see how this one played out. But how can you, in good conscience, as a value investor, they lose 50% of their free cash flow margin, which can happen. When was the last time that happened? Let's go down to the single years. Look at that, 7 down to 4.7. You know, significant drop. 7% down to 2%, more than 50%. Very risky. The upside could be significant, but boy, is that risky. I'm not gonna. Like I said, the very fact that you can lose, they'd be gone. What did we say the thing was? 232. 234 going forward. Straight away, they lose 50% of their free cash flow margin, which is possible because Lexmark was negative. Boom. Yawn. 1 million shy, which you can take from cash. They've got enough cash to cover that. More than enough cash. Looking at that. Wow, they could go for almost 2 years just on the cash. Is 2 years enough for them to turn it around? It's not like they're not. I don't know if we looked at this in the last one. Let's have a look. I want to see what the insider holding level is. I should just open that. Control F, beneficial. Darwin Decent. Who is this Darwin Decent then? 12% owner, BlackRock Vanguard. I mean, that's nothing to them. Nothing at all. Here we go. The amount beneficially owned by all directors and executives of the group is approximately 1.5%. It's not huge at all. Just see who Darwin Decent is. Billionaire businessman, sold it. Oh, okay. Xerox. Founded. Sold it to Xerox. Still highlighted. There we go. Darwin Decent, no change. 12.5% ownership. 71% of his portfolio. What's on the rest of his portfolio then? Conduit Inc. Blah. The uncertainty, right? Factor Ramen and Iron should be immediate. No, it should be. I've read enough stuff from other investors for that. This is in the gambling pile, in it. Gotta be. As interesting as this is, mine $232.32 for 363 share price. debt is significant and the interest expense is significant, but 234 million a year interest expense, you've got 400 million in cash, and you're making, 300 million there. Oh, honestly, got a problem here though. Got a problem here because that can't be correct. Let's get that up and have a look. This is why you got to check your data. 0 chance of no capital expenditures, surely. $39 conditions, cost of addition to land buildings, equipment, software. So, is that the 6 months? Let's have a look. 6 months, yeah. See what it was before in the first quarter, just so we can get it accurately across the quarters. This is going to obviously potentially significantly change the cash flow. Where am I looking? Balance sheet. Why have we got so many here? Look. Balance sheet, cash flows. 20. Right. 20 million. Oh, make sure it's negative. 20. The other one 19, wasn't it? 39 in total. Right. Now 253. That's still $2. 253 in free cash flow. That makes it even worse, actually, doesn't it, when you look at it compared, 253, and they've got themselves like a 600 million leeway, 2 years to sort out their debt. What a gamble that would be. I'm going to stick it on the blue list, on the let's watch this list. Oh, dear me, they're still paying a dividend. Why are they paying a dividend when they... Obviously that would crush them again though if they stop paying a dividend. Oh, dearie me. You can see interest expenses crept up, look. First one since acquisition, bumping 33 to 55. So yeah, if you times that by 4, you are looking around the 234 million range that it reckons, 220 million. Oh, dearie me. Sort of excited to watch this one, but I won't be touching it. The umming and ahhing is obviously the sign you shouldn't be touching it, isn't it? Be interesting to see where this goes. It has a chance, but dearie me. Can Lexmark save Xerox? I say maybe. Company's valuation is attractive. A price target, making a speculative buy. Speculation is the key word in this one, isn't it? From what we've seen. Got request to cover a recent deal between Xerox and Lexmark. Lexmark's not as bad business at all. Okay. Current estimate comes to negative net income on the balance sheet. Have 8.3 billion equity and liabilities, only 1.5 billion in shareholder equity, and the company's net debt comes to almost 3 billion. also continue to pay dividends despite negative net income and poor earnings. Free cash flows nonetheless stay positive for years. %8 margin. Its coffers have been draining on an annual basis, going from around 208 billion to 600 million where they stand today. This is obviously an old one now because we can see it's less than that. It's like 200 million less than that. I believe this is 2024, yeah. Speculative. So I skipped quite a bit of this article now, but it's what it is. Offers good A4 segment market. Also because the transaction is expected to immediately accretive, there's very little speaking against this, though it certainly muddles the current iteration of the company's reinvention program. However, this will reduce leverage and this is a net positive. Point 15 times. Come to an analysed upside of 40% or 100% in 3 years. Oh, this is not me saying this, by the way. This is this geezer saying this. Everything I'm saying, you can tell, is accompanied with sighs, head scratches, which as a value investor should be a no, as I've repeated several times. Alright, I'm going to leave this here. I'm going to leave this video here. It is now gone 1 AM to finish this video. Almost a bit excited really to see how this one turns out. Obviously it's going to be a long-term thing, but it could be huge, it could be disastrous. Like I said, about 2 years, 400 million in cash, 200 million simple free cash flow, 234 million to cover a year. They are wiped out effectively should their simple free cash flow margin drop by 50%. I mean, they're not wiped out, they've still got a cash position, but effectively they're done. And we've seen drops of, free cash flow margin of 20% twice, 50% twice in the last few years. Interesting stock, that, isn't it? I pay no more credence to this though. This one here that said Joel Greenblatts and all that's bought into it. They haven't, not of any conviction at all. 0.01% of their fund. There's no conviction in that. That is just, repositioning of indice type investments, I would imagine. Anyway, interesting times for Xerox. We'll leave it at that. Thank you very much. Like and subscribe, and I will see you on the next one. Hopefully get it out a lot faster than I got this one out. Waited far too long to put out another video, especially if I want to try and grow the channel. Anyway, thank you very much. Take it easy. Look after yourself. Good night.